There's no shortage of risks out there for the markets, from uncertain trade policy out of Washington to the threat of sticky inflation. But how is the corporate bond market holding up in the face of all these headwinds? Joining us now to discuss, Rashna Nabat, VP Director and Lead for Investment Grade Portfolio Management with TD Asset Management. Great to have you back on the program, Rashna.
Same here, Greg. Great to be here.
These are interesting times. Obviously, with that interest comes a lot of risk as well. No shortage of those risks out there. We have, however, seen some different reactions, whether between the equity markets and the credit markets. What's going on there?
Right. And actually, that's a great question to start off with. And if I were to ask you to paint the picture of the world just by looking at credit spreads, you would see a much calmer and more quiet, more stable, picture versus what equity markets would have told you. For context, credit spreads this year have really moved within a range of 5 to 6 basis points. So call it from trough to peak, it's been the 5 to 6 basis points. And remember, spreads are already historically very tight. So any news, it is supposed to be more vulnerable, but it's not. So yes, it's been more resilient. And the main reason for this resiliency has been attractive yields. And if you look at the chart here that I've brought with me, if you look at US investment grade credit, it's offering about 5.1% in yields. So you earn about 5.1% yields. Canadian investment grade, you earn about 4% in yields. Think about this. You're able to lock in these attractive yields by buying these high quality companies, right? We're talking about companies like Bell, TELUS, Loblaw in Canada, and you're talking about Bank of America, JP Morgan. So very, very solid companies, diversified, have operational flexibility in their business, have strong pricing power, and they're offering these attractive yields. So it's a pretty good value proposition if you think about it. From in a world where default risk is likely to remain benign, macro is doing okay. There are concerns, but for now it's doing okay. So in a world that's doing okay, and those yields are being offered by high quality corporate bonds, guess what? There's a reason why that demand has been on fire. And you're seeing that demand come in week after week in terms of new money flows into this asset class. That's not it. Even the credit portfolios that we manage as portfolio managers, the coupon income that we earn has been increasing over the last 2 years, right? Because interest rates have been rising. So we're earning more income, and there's a natural need to deploy that cash without even relying on outside money to come in. So that demand is coming from many, many pockets, right? So anytime you've seen a small dip, let's say 5, 6 basis points, because the economy is okay, default risk is benign, corporate fundamentals are in good health, you've seen those dips being bought very quickly. The other reason for why the resiliency has been the case is you have to always remember that we're talking about credit markets and not equity markets. Equity markets focus on earnings growth. For credit markets, the earnings growth has to impact credit metrics. So it's a two-step process before it hits spreads, right? And not every earnings growth means an impact to credit metrics. When I say credit metrics, I mean leverage, so gross leverage, interest coverage. Those ratios take a little more for them to be impacted, and companies have done a great job building buffers in. So those are some of the key reasons for why you've seen that resiliency, and the biggest reason are those attractive yields that you're seeing.
So we see the attraction of the space and why it's showing this kind of resiliency. What are the risks, though, to the credit markets in an environment like this?
There's surely risk, right? And it comes from the fact that spreads are so tight. So as a credit manager, I hate these spreads, right? It's frustrating because it makes my job even harder to find value because the opportunity set is so small now. But in and of itself, it's not the reason. So tight spreads are not a reason that you should worry about corporate credit market. It's been that way. If you look back 40 years, there have been periods where spreads have been tight for a longer period of time. But when I think about risks, what can actually break the resiliency here? What can break, in my view, is something that causes a shock to both fundamentals, so corporate fundamentals, and technicals. When I say technicals, I mean that demand technical that I just spoke about. So let's think about what can cause that. What can cause that is a massive, severe global growth shock. Maybe it's driven by tariffs. I don't know. It could be something else. But when that happens, what would happen is people will start losing jobs, the demand will fall for companies, the free cash flow will shrink, and it ultimately impacts credit metrics that we spoke about. On the technical side, what happens is the demand side, as I said, what's driving spreads to be tight are those attractive yields. So those yields will fall because central banks will step in to cut interest rates at that point. So yields are going to drop. So it's a double-edged sword in the sense, and that's the biggest risk I see for credit in a scenario where we see a severe global growth shock driven by a tariff or something else. There's another risk that you have to keep in mind, which it will be a risk-off move, but may not be as material, and it depends. And that move is if, let's say, the yields start to rise up, and you have an expectation of, let's say, inflationary concerns, and you expect yields are going to rise. Rising yields means price losses. If you believe that yields are going to rise and inflationary concerns are going to come, demand will step back. But it'll be temporary in nature, because once it stabilizes, you see that demand come back in. So those are some of the scenarios that I believe can be, a widening event for credit. But overall, dips are likely to be bought. This is how the setup is right now at current yields, unless we're talking about stagflationary concerns, right? Which is slow growth, but inflation is a concern. And that could be a problem for credit. But for now, the base case is that the credit is a material widening that eats into your total returns when you invest in corporate bonds. High quality corporate bonds, it's quite low at this time, which is why we believe that investing in corporate bonds is the right place to be.
Okay, so important things to keep consideration there in terms of the strengths, the attractiveness, some of the risks. We often talk about credit markets in broad strokes. Of course, there are different markets, different geographies. But let's talk about the U.S. and Canada and some divergence we've been seeing there.
Yeah, I mean, it's a really important point to talk right now. Obviously there is the tariff risk, right, which can be severe, which can be sustained for a long period. And if it's severe and sustained for a longer period, it's going to be a problem for this economy. It's not been very often that Canadian corporate spread will diverge a lot from the US investment grade spread. Because look, Canadian economy is deeply intertwined with the US economy in terms of trade flows, in terms of financial flows, and economic growth. 1 in 7 jobs in Canada rely on the US, Canada-US trade. So if there is a severe, tariff, let's say 25% tariffs, and they're implemented for a longer period of time, that is going to be bad for our macro. The direct risk for investment grade credit is low. When I say direct risk, I mean the exposure to, let's say, auto sector in investment grade space. Where you'll get the impact is more from the macro angle, where people start losing jobs. If it affects everybody, all the companies, right? So that is a scenario that one has to be mindful of. But question is, do you really think we'll get severe tariffs for very long? I'm not in that camp, and the reason being, more than 30 states in the U.S. Actually, Canada is their top export, country. Why would Trump want to hurt American businesses? Midterm elections, we shouldn't forget that. It's next year, right? And to be able to govern effectively for the later part of the term, it's important that he wins it, right? The party wins enough seats. It's narrow right now in terms of the majority in the House. So those are some of the reasons why I believe, again, that's a different discussion altogether, but coming back to corporate spreads, I do believe that what is possible is that this overhang on tariffs creates uncertainty for CFOs, treasurers on capital allocation decisions. So let's say companies have a plan B right now that, I want to move my production to the US because it's so uncertain. So slowly it can trickle into your economy. That could mean modest widening. But even in that scenario, the Bank of Canada is ready to cut rates if that happens. What does that do? Well, for corporate bonds, it means your total return is still positive. And if if that scenario doesn't play out, well, corporate bonds are giving you enough income that you should be investing within corporate bonds rather than moving to government bonds at this time. Because that scenario of severe tariffs is still a low likelihood, or is not the base case at least.
All right, we put all of that together. How should investors be thinking about positioning themselves in the corporate credit market?
Yeah, I mean, it's challenging. And the reason it's challenging is because, there is a base case everybody works towards, but it's not necessary that actually plays out. So you always have to build resiliency in your portfolio, right? And you have to make sure that, and the problem is the yields are so high. Spreads are tight, but yields are high. So if you're underinvested, you're not putting that cash to use, you're not making it work smarter. And as we discussed, Canadian corporate bonds, the risk that you actually go negative on total return is low, because you'll get that offset from fiscal and monetary policy. You'll get the offset from currency as well for companies, on the demand side of things. So there are reasons why one can be constructive on Canadian corporate bonds, which means you should be invested. But how you should play this out is you should be in the right sectors. So choose the right sectors, which will underperform less in a downturn and outperform, in when things rally as well. So there's a balance out there. For example, right now, when you look at the defensive sectors like telcos versus discretionary like Canadian Tire, the spreads are very compressed. So why not switch from cyclicals to defensives, right? So I think those are the ways you can protect your portfolio or go into higher quality. Because, for example, right now there are some pockets where BBB credits versus single A credits, the basis is very small. So why not upgrade your portfolio and focus on shorter corporate bonds? Because, for context, unless you expect a 50 basis points more in corporate spread widening, which is unlikely, by the way, that's the situation where your total return might be negative, but it's such a low likelihood. It has to go almost above 75 basis points in widening, which is not a scenario right now. So in short, I think you pick the right spots on the curve, which is shorter corporate bonds. You stay in Canadian corporate bonds because you get that offset from Bank of Canada in a situation where spreads widen. And you focus on the right sectors and you upgrade your portfolio. Focus on high quality bonds rather than lower quality bonds. I think that's how I would position at this time.